I am joined by Ares' new co-presidents, of course, Kipp deVeer, Blair Jacobson. Thank you both for joining.
Thanks for having us.
It says a lot to name both of you at this time. A lot of people being elevated across Wall Street, but in this particular instance, this seems to be a lot about growth. What are you growing into that are saying things about the future of where Ares is going?
Yeah, thanks, Sonali. I mean, I can start. I've been here for 20 years. The firm's changed a lot. Obviously, we're at a point now where we're truly a global firm. There's been a tremendous amount of growth. It's 3,000 plus people and growing. And what I'd say for me is it gives me the ability to kind of step out of my day-to-day, having run the credit business now for a while, and try to tackle some of the most important strategic and operational initiatives that we're focused on around the globe. And obviously thrilled to be giving Mike a little bit more help on a whole handful of things.
We'll talk about those areas in a moment, but this also means, and by the way, Blair, you are the really only set of co-presidents across both sides of the Atlantic. It says something about your global growth strategy as well. What does it look like to expand into other parts of the world?
Being global has been really important for Ares. We've been global for almost 20 years. We have 1,000 people outside of the United States, almost 100 billion of assets. So I think when you look at it, again, it is unique to elevate co-presidents in both New York and London. And certainly it recognizes all the hard work and efforts from teams around the globe as we seek to take the Ares playbook to new geographies and to new products.
Now, one thing we were talking a little bit earlier with your CEO, Mike Arrighetti, about is when you look at the market right now, there are a lot of jitters out there. That looks different on both sides of the Atlantic. Certainly both regions have its own challenges. Blair, walk us through how you're navigating some across Europe in particular.
Sure. I think as we come into 2025, you exit 24. 24 is a bit better than we expected. The economy's kept growing, albeit at low levels. Rates came down. However, we had record deployment levels. So what we're seeing going into 2025 is big amounts of private equity on the sidelines. It's coming to play. Cost of capital's down. When you see interest rates down 50, 150 basis points, that has a big impact on how deals look. So I think the big questions that we have are really around the political frame. We had a big election year last year in the UK and in France. We had Germany just last week. So the real question is, how does that impact 2025 from a policy perspective? But we really aligned ourselves in sectors that I would say are less directly correlated to potential tariffs and changes in defense spending.
That interest rate story here in the U.S. has been not the same as you saw in Europe. In fact, if you look at the 10-year yield, yes, you see a very significant move in the yield, but a lot of that is on the back of growth concerns. With a volatile market and growth scares, how do you get anything done as a private equity firm? Are you sitting there, Kipp, talking to private equity firms saying, we need to lend you more money now because you can't take your companies public anymore?
Yeah, I think everybody's waiting for that M&A machine across asset classes to pick back up. We're seeing some early signs that that's happening. The backdrop here in the U.S. is pretty good, and the question I'm getting a lot from investors is about sort of U.S. exceptionalism. Everybody actually wants to be invested in the U.S., but to your point, it's not quite as busy as folks would like it to be to deploy the amount of capital here that I think everybody wants to put to work. And the other concern, frankly, is that markets haven't really corrected all that much in response to a pretty significant uptick in rates. Right, so markets feel expensive, but there's good confidence in the economy, generally in the consumer and in companies. So I think everybody wishes we could be a little bit busier. And again, we're seeing signs it's picking up, but it's picking up slowly.
That's a great place to ask how you're deploying capital, because both of you have seen record-breaking funds compiled at Ares in the world of private credit, certainly in Europe as well as in the United States. How fast is that being put to work right now?
Yeah, the good news is we had record deployment last year as well. So the key, as I've always said, and I've said this to you in the past, is if you're willing to continue to invest in the origination and risk management machine, i.e. putting people on the ground with specific asset level, expertise and origination frameworks to drive that deployment, and you have confidence in those people to continue to pick the right risk reward, deployment isn't really a problem here.
Yeah, I would just add on to that from a European perspective, it's really 5 or 10 years behind the U.S. market when you look at penetration of private credit. So that in and of itself provides an inherent tailwind.
Over across the street, up the street really, at Apollo, there's another thing happening where today they've launched a private credit ETF with State Street. We spoke to your CEO, as we've been talking about, Mike Garrighetti, about this. He talked about how, well, you have things retail investors can invest in, things like BDCs. The question is, how much liquidity do you really need to get more retail money into this strategy? This has been a strategy that has been largely for large institutional investors that can hold and lock up their money for a long time. What happens when people want to pull their money out with more frequency?
Yeah,
Would you
I think
do an
that's
ETF, Kipp?
specifically that's the question that we would ask. I mean, I'm gonna roll that back a little bit, and it's funny, I hadn't seen any of that news about that. No one's been asking us about that. So, look, I mean, I think what it is a very clear indication that this market has evolved a lot, right? Investing in private credit, private markets is increasingly attractive to a different set of investors, right? Where we've grown the firm up historically around institutional investors, pensions, insurance companies, sovereign wealth funds, et cetera. You know, the other side of the aisle, so to speak, the retail investor is now saying, how do I get access to these products? They seem to offer great risk reward. They seem to offer premium returns relative to what I can get elsewhere with less correlation. And they're not beta driven, they're alpha driven. So it doesn't surprise me that ETF has come into the world of distribution, but we've been diversifying our distribution substantially with our wealth business, for instance, and we've chosen to attack that for the most part with non-traded REITs and BDCs. Would we ever do an ETF? I don't know. We don't really have anything in the works right now, but we're certainly interested to see how it goes for our friends, up the street.
Watching, waiting.
Yeah,
you know,
sure.
those non-traded BDCs, it's quarterly liquidity. Is daily liquidity appropriate for this asset class?
Well, I mean, it depends how you manage that liquidity, and I can't say that we've really dug in and looked at the liquidity mechanism that vehicle in particular provides. I think Mike said this when you spoke to him before. There are ways to access private credit in daily liquidity vehicles. I mean, you can buy stocks in BDCs, right? You can buy stocks in mortgage REITs.
Buy stocks in Ares.
You can buy Ares stock. You can buy, correct. So there are a lot of ways to get that exposure. I would probably kick the question on would we do an ETF or not to somebody on our product team who probably is smarter on it than I am.
You know, this all comes down to a question that investors have been asking about this asset class now for years. Where's the risk, right? It's hard to see what's moving under the surface in an asset class that is more private. Where is the risk? When you look across the board here, are you seeing some risks under the surface, some cracks under the surface?
I say the typical question is first on operating performance, and through very careful credit selection, our companies tend to grow much faster than GDP, so that puts us in good stead. The risk, however, in particular that we're focused on as rates started to go up in 22 is more around liquidity. Can the companies afford to service higher rates on floating rate assets? Which, by the way, floating rate assets, higher rates is actually good for us. We've made it through that, especially now that rates are coming down. I think the questions in the near term are going to be around refinancing risk. You know, companies that took on loans years ago when maybe the economy looked different, the rate picture looked a little bit different. Have they grown? Can they afford to refinance? Then the final question for longer in the future is, how do these companies actually exit? Going back to your original questions around M&A.
So M&A is one part of the story, getting from one place to the other, but then that stress that you're talking about that could be brewing from some of these refinancing risks, what opportunity does that present to you guys? Because you are focused on an opportunistic strategy as well.
For sure.
In the golden days, in the olden days, those were thought of as distressed opportunities. Are they still distressed?
I don't think that we're the only ones onto this theme, but I think the world that we're living in is you have companies that borrowed a fair amount of debt, assuming that they would have cash flow that would allow them to create equity stories for the equity holders. Then all of a sudden, with a significant rise in rates, a lot of that cash flow is going simply to service debt. And to Blair's point, they're able to service that debt. You haven't seen defaults spike. You haven't seen non-accruals, in credit portfolios go up. But you see challenged equity stories and folks with an inability to exit. So in each of the corporate asset class, the infrastructure asset class, and the real estate asset class, that hybrid capital piece that very often can't collect cash interest, but can target equity-like returns in good companies with a lot of downside protection, we think presents some pretty good risk reward across the firm.
Are either of you seeing real stressed opportunities out there to dive into?
From time to time, but not any more so than in the past.
I think it's probably a little bit early and maybe a bit more sector specific, but that's not the biggest trend we're seeing at the moment.
Really quickly, last one for you, because you had mentioned that refinancing risk. Realistically, rates are still relatively high. Are companies able to take on new debt loads at the rates that we're sitting at now?
I think certainly some are, again, higher performing businesses in good sectors, but there will always be some that Kipp mentioned earlier where they need a little bit of capital to delever their capital structure in order to affect refinancings, and that's coming from opportunistic credit that you mentioned earlier. It's coming from equity sponsors themselves, so they do have options.
It's been a long while since we've heard deleveraging being the hot story on Wall Street. Thank you both for joining me. Of course, that is Kipp, deVeer, and Blair Jacobson.